Thanks very much, Francis. Well, global markets seem to be in sell-off mode today, as you did mention, Francis. This after a good run, perhaps it's just investors taking a bit of profit. Maybe there are other reasons. We'll get some analysis in just a short while. The all-share index has also lost ground, but it's still above that 60,000 points level. So it's still very high indeed. The gold price has edged up on the back of that weaker dollar, and the local currency did make some gains earlier in the session relative to where it closed in New York last night against the US dollar, but it seems to have made losses yet again, so not doing very well at the moment. Let's take a look at the indicators. Well, I'm joined by Michael Traherne. He's a portfolio manager at Vestact. Thanks for joining us, sir, as always.
No, great to be here.
Good stuff. Market seemingly subdued today. What's going on?
Yeah, look, even though we've got used to it, stocks can't always go up every single day. So it's just a bit of going sideways, I suppose. For the week, we're still higher. And I suppose that's what matters short term. It's, above 60,000, like you said.
And from your perspective, in terms of the fundamentals, when you look at the corporate earnings that have been coming out, global fundamentals in terms of the economy, things still looking good?
Yeah, so I think one of the things we need to look at is interest rates have a very big bearing on what stocks are worth. And as long as interest rates are below historic levels on average, stocks are going to be trading above historic values on average. And if we look at the US last week, Donald Trump appointing Powell as the new Fed chair. He's known as a very dovish person, which means he's not looking to raise interest rates anytime soon. So that looks to be set. We move over to England. The Bank of England did raise interest rates, but they did say that over the next couple of years, they only plan to raise it by another 0.5%. I think it was between now and 2020. So again, there's not much movement on the interest rate front. And Mario Draghi coming out and saying things are going to be slow. Generally, they're going to start cutting back on their bond buying program. So for overall levels, stock earnings were in line with what the stock market's showing, and interest rates are set to rise very slowly over the next couple of years. And you combine those two, you get to record highs on the stock market.
Okay. And now what's coming out of the US in terms of those proposed tax cuts is that it might take a bit longer than was anticipated. Has this been negative for US markets? I see that the dollar has declined as a result.
Yeah, it's a little bit. Donald Trump's basically said he wants to give the new tax plan as a Christmas present to the American people. Economists are being polled over this, most saying beginning of next year to the middle of next year, and that's sort of what they're expecting. So we're going to have to see. The main thing is to getting all the Republicans on board, and if they do that, then they have the majorities that they need to push things through most of the way. At the moment, it looks like the Republican Party's on board with the tax cuts. You remember, you go back to Obamacare, there wasn't agreement there. Some Republicans saying the cuts weren't big enough, and other ones saying the cuts were too big. But that doesn't look like the problem at the moment. But if this doesn't go through, you definitely will see the stock market pull back, particularly in your big names. I mean, Apple's got close to $300 billion that they're looking to bring back to the US. If the proposed tax cuts don't go through, then offshore funds won't be able to make their way back into the US. No reinvesting. It's not great.
And then here at home, obviously, we're all anticipating what the ratings agencies will do on the 24th of November. What's your expectation, and what do you think is the worst case scenario?
Yeah, so I think the most important thing here is the graph that Malusi Gagaba put up of our deficit. Going into this year, it looked like we were going to top out 2018, 2019. It looked like we were going to level off, and our deficit was going to start reducing. But because of the massive under-collections at SARS, and also a very big scale back on our growth projections, Our deficit looks like it's going to keep continuing, and the graph actually didn't show it leveling out. And given that that separation, rating agencies are going to go, you're a lot more risky, more than likely going to downgrade our local debt to junk. And the result will mean that we're no longer part of that Citigroup Emerging Markets Bond Index. And as soon as you remove from the index, anyone who owns the index has to sell your bonds. And also then guys who own your debt because you're investment grade then have to sell you because you're no longer investment grade. And the result then is obviously South Africa has to pay more interest, which means we have to borrow more money, which makes the problem worse, and then just repeat the cycle. So not great long term. Immediate impact will definitely, you'll see the rand weakening. Although at 14.20 we're still a long way away from Nenegate when we got close to 17. And also if you have a look at our bonds, they're trading, our 10-year is just over 9%. Nenegate, I think we got over 10%. So we're not quite in that territory yet. I'm not 100% sure what the market's expecting, but most people that I've spoken to do think downgrade is inevitable.
Now, with all the uncertainty and with the financial stocks being so, what can I say, very sensitive to what happens on the bond market, how has this affected financial stocks? Have they been pretty negative?
Yeah, whenever you see big news coming out, and particularly on the day of the medium-term budget, you saw them suffering. And the main reason, or there's two reasons. One is financial stocks track your GDP very closely. Obviously, if things are growing, people are lending more money, people are swiping credit cards more, they're just doing general more transactions, your banks do better. The other thing to consider is that they need to hold South African debt as collateral for the deposits you put in. Now, if we get downgraded to junk, it costs them more to hold that debt, and potentially they have to swap the debt, they have to sell at a loss and then buy a different debt that isn't junk rated. So it's a bit of a double whammy on that front. Having said that, though, our banks are very, very well capitalized. We've got some of the best banking regulations and systems in the world, and that's why we did so well through 2008, was because of how good our banks are. But in general, if the economy is struggling, financial stocks are struggling, debt downgrade means that we're not going to be doing too well going forward, and that's why you've seen the financial struggle.
All right. Well, we're going to leave it there. We've run out of time. Thank you very much for your insights, as always, Michael. Financial stocks taking the brunt or feeling the brunt of the uncertainty as to what will happen on the 24th of November. We'll continue to have those conversations with our analysts as we approach that date. And after a short break, Francis will have more business news for you.